This is Josh Jalinski, the financial quarterback. Don't touch that dial. Hi, everybody. I'm Josh Jalinski, your financial quarterback. We're with Liz Ann Sonders of the On Investing podcast, Schwab, Chief Investment Strategist, also part of Smart Money's Power 30, named the best market strategist by Kiplinger. So, Liz Ann, for those who are not familiar with your work, describe what brought you to Schwab, where you're a big financial talking head now.
I started in the industry in 1986, right out of undergrad, and I spent 13 years at the Zweig Avatar Group, co-founded by the late, great Marty Zweig. And I started as a grunt and ultimately became a senior portfolio manager. And then in 1999, I joined U.S. Trust, which 10 months after joining U.S. Trust, it was acquired by Charles Schwab. And shortly after that acquisition, Chuck Schwab himself came to New York and met with me and said, we want to create this role of Chief Investment Strategist, which had not existed at Schwab before. And he said, any interest? I said, absolutely. And that was 25 years ago. So that's how I came to Schwab.
Great. And how did you get interested in investing?
Frankly, when I graduated college, I didn't know what I wanted to do other than I wanted to live and work in New York City. So pounded the pavement, had interviews across the spectrum of industries. Something clicked at the time, joined Zweig Avatar, and then fell in love with the industry. Sort of grew up in the business under the tutelage of Marty Zweig, who was just an icon and a pioneer in everything from monetary policy analysis. He coined the phrase, don't fight the Fed, sentiment analysis. He invented the put-call ratio, the Zweig breadth-thrust model. So really learned the top-down aspect to markets and the interconnection between markets and the economy. I was in the bottom-up role of being a portfolio manager and a stock picker, but I was always much more fascinated by the top down. So that was part of the reason why I jumped at the opportunity to move into more of that top down role at Schwab. I think having had that portfolio management background probably informs the way I think about markets, but I certainly love the top down aspect to what I do more so than my early start as a portfolio manager.
Great. And what was the best lesson or one of the best lessons you've learned from Marty Zweig? I've heard a lot of good stories. I knew somebody else who worked under him.
Understand that there is no silver bullet, that even if you've got a group of tried and true indicators, that there is no silver bullet. That he coined the phrase, the trend is your friend. So staying directionally with the market, even if it's in contrast to what a lot of the quantifiable metrics suggest is appropriate, and also understanding just how important psychology is to where you are in the market cycle. I remember it was Marty who pointed out the late, great Sir John Templeton's famous quote about bull markets are born on pessimism, they grow in skepticism, they mature in optimism, and they die on euphoria. Marty was the person who gave me the first book I ever read on markets, which was Reminiscences of a Stock Operator, which is very much about the psychology of investing and the emotional component of it. So those were probably the most valuable lessons I learned, is understanding how important psychology is into market cycles and investor behavior.
And where are we now in the market cycle? Everybody wants to know.
Yeah, well, this is an incredibly unique cycle, both in terms of the economy and the market. In terms of the economy, it's an abnormal cycle where we've had rolling strength and weakness over the last 4.5 years, going back to the early part of the pandemic, where you saw the initial surge in growth, and in turn on the inflation side of things, concentrated in the goods part of the economy because of course services were shut down. We then actually had recessions, hard landings in manufacturing and housing related, a lot of consumer goods. We just had the later offsetting strength on the services side. Services is a larger employer, helping to explain the resilience of the labor market. And that has infiltrated market behavior too, where you've had these fits and starts of market behavior that haven't been collective in nature. 2022 obviously was a bear market year, but the weakness was really concentrated in the mega cap stocks. And then when we got to the October low, that was when you saw this underlying improvement in breadth. That was a pretty interesting signal of kind of a positive divergence. Then 2023 and into 2024 was a story just of index level kind of gains, where you saw much more churn and rotation and weakness under the surface. And so any comment about how could the market in this cycle be so resilient in the face of fill in the blank economic vagaries and geopolitical uncertainty and election related uncertainty? Whereas if you look under the surface of these cap weighted indexes, you actually see that the churn and the rotations have been a little bit more connected to what's been going on in the economy, whether it's goods versus services, other ways to break out this backdrop of significant bifurcation. There's been a lot of K-shapes to define this economic cycle, and that has applied to bifurcations and sort of K-shape aspects within the equity market as well.
What about the Fed? Do you think rates are going to stay low, or are they going to have to raise them next year because inflation's persistent?
No, I think at this point, given what we know now, I don't think the bias is to move back to tightening policy. I think it would have to take a pretty significant and also sustained shift back higher in inflation for the Fed to move away from what their desire is, which is to be in an easy part of the cycle. Now, that said, there's some decent inflation data between now and then. There's labor market data, not just the next jobs report, but also weekly type and labor market data that will undoubtedly change the market's probabilities around what the Fed is going to do at the November meeting. But I think the path of least resistance is still lower, barring some significant shock on a sustainable basis on the inflation side of things. I also think it's important that the Fed, in making their decisions on a going forward basis of, when to cut by how much, is keying much more off the labor market now than inflation, which is what obviously the Fed was keying off of in their tightening part of their cycle in 2022 and into last year. So I think really it's trends in the labor market that in the near term will probably dictate more those changing expectations around what the Fed's going to do at the next meeting, the meeting thereafter.
What do you think about the labor market?
It's quite resilient. And I think that's testament to some of it having to do with demographics, the supply problem that we still face in terms of labor shortages. I think that there is credence to the idea of labor hoarding. And even when you started to see some fairly mild cracks in the labor market, and you did witness it in things like hours worked having come down, but you have not seen a big surge in layoff announcements. You haven't seen a big surge in claims. So I think that points to this idea that as companies think about the cost side of their equation, protection of margins in a declining top line growth environment, at least for now, the default switch has not been set to let's cut costs via the labor side of the equation. They've been able to find ways to maintain margins and boost productivity without having to take serious cuts to labor. And then, of course, the most recent jobs report, which is only 1 month, but pretty much every component of that was strong. And bucking recent trends, you actually had positive upward revisions. I also think that ongoing resilience in the labor market, assuming that's what persists, is not just key to the Fed's reaction function, but is a direct feeder into why consumption, which is nearly 70% of the US economy, has been so resilient. Even though excess savings has been drawn down to a large degree, the savings rate, although recently revised up, is not robust relative to history. I think that connection point in terms of resilient consumption has been because of the labor market. As a result, any significant weakening in the labor market, which is not our base case, I think would probably translate into weaker consumption patterns relatively quickly.
Where do you see the Dow headed in the next 12 months?
You want the honest answer that anyone should give that gets that question? I have no idea.
Yeah.
One of the reasons why I love what I do at Schwab and why I was intrigued at this opportunity 25 years ago was one of the first things Chuck said to me was, one of the things I don't think we want to fall into the trap of doing are in general trying to pick tops and bottoms in the market, and more specifically doing exercises like year-end price targets. And that was such music to my ears because no one has the ability to forecast markets. And I always say to our investors, it doesn't matter what we know. I know, they know, some other talking head knows, meaning about the future, what the market is going to do. It's what we do along the way. Neither get in nor get out, which is often what's driven by target prices and trying to time corrections both at the front end and the back end. Is that get in, get out is just gambling on moments in time, and investing should be a disciplined process over time. Look, I know it's much less exciting to talk about. People want to have a guest on a podcast or on financial television and hear the bombastic call on the market, but it's just guessing. And I don't think that is the key to success for investors. It is around the things that are arguably more boring to talk about, which is diversification across and within asset classes, the beautiful discipline of periodic rebalancing, because it forces investors to not just do a version of what we know we're supposed to, which is sort of add low, trim high, which is a version of buy low, sell high, but it often forces us to do the complete opposite of what oftentimes our emotions will drive us to do, or our perceived gut instinct will drive us to do. That's the stuff that matters, even if it's maybe not as interesting a thing to talk about in a format like this. So sorry.
No, I love that's what I cover. I love all the stuff that you should do, the behavioral investing side, the investing principles. I get so many people that talk to me. I mean, this goes years ago. Obama's in. I'm worried about, should I sell all my stocks? Trump's in. Should I sell all my stocks? But now you get the reverse of it. Like, oh, darn, I shouldn't have sold years ago. I want to get back in. What should I do? And that's where I think some of the questions of forecasting is fun, even though it's sort of an exercise in futility.
It is a huge exercise in futility, especially if it's all or nothing, because it requires you being right twice, not just once. One of the biggest beneficiaries of this win is likely to be the energy sector, given that the energy sector in the S&P 500 is dominated by traditional energy companies. There's no green energy, no solar energy companies in there. Well, from inauguration day to inauguration day under the Trump administration, the energy sector, out of all 11 sectors, was the worst performer, and it was the worst performer by a massive margin. It was the only sector down in that 4-year period. It was down 40%. The next worst sector was up 20%. Well, fast forward to the Biden-Harris administration, seen as anti-traditional energy and pro-renewables and green energy. Again, the energy sector as we know it is dominated by there's no green energy companies in there. In fact, almost half the sector is ExxonMobil and Chevron. Well, from inauguration day to yesterday's close, under the Biden-Harris administration, energy is by far the best performing sector, even besting technology. That is not to say that secretly Trump was anti-traditional energy and secretly Biden-Harris are pro-traditional energy. The point is there's so many forces that impact what markets do, what sectors do, what stocks do. We get in our head thinking that it can be directly tied in a sustainable way to party or person, even makeup of Congress. And it just doesn't work.
You were talking about diversification, dollar cost averaging. What are some things that you like investing principles wise, like that from your observation in the markets? I mean, I have mine that that I tell people. Some from Marty Zweig, some of his old research. And there's a guy that I follow that kind of uses his research still, and he follows all the Zweig bond model and this and that. But any things like that, for personal finance tips?
Yeah, well, some of them, I touched on, tied to Marty and otherwise, around understanding the emotional side of investing and understanding the benefit of staying with the trend, even if it's in contrast to maybe what some of the quantifiable indicators suggest. But one of the principles I think is important, particularly for individual investors to think about is, well, first, have a plan. Whether you devise it on your own or you sit down with some sort of financial advisor, and that long-term plan and the strategic asset allocation associated with that, the decision or desire to maybe have a tactical approach as well, that is all tied to time horizon and risk tolerance and need for income and tax bracket and where other assets might be in terms of what the investment portion is going to represent from a diversification standpoint. All of those facets go into that financial risk tolerance. But probably the most important thing, ideally, to try to assess before you learn the hard way, is whether you have a yawning or narrow gap between your financial risk tolerance and your emotional risk tolerance. And I certainly know plenty of people that on paper, they think I have a high risk tolerance because fill in the blank. I've got lots of time. I'm not retiring for another 30 years. I'm not living on the income generated from this portfolio. But if at the first 15 or 20% drop in your portfolio, you're going to go into freak out mode and panic and sell, I don't care what your financial risk tolerance is on paper. You are not a risk tolerant investor. So I think that trying to sort of turn the mirror on yourself and say, okay, what can I actually withstand given what we know about market cycles is really paramount to that long-term success. The other way to think about the emotional side of things and how it sometimes plays tricks with us. I'm going to give you an example of this. And it was such a fascinating conversation that I had with a client a few months ago. I was out in the Bay Area where there's always a lot of interest in the tech stocks, and I had a client come up at the end of the event that I did, and he was very lovely, but he said, "I'm a little bit annoyed. One of your, meaning Schwab's financial consultants, has been telling me that maybe I wanted to trim a little bit of my Nvidia position." He said, and I trimmed about 5%. He had suggested 10, but I wouldn't give in. I trimmed 5%. And the stock has gone up 20% since then, and I'm really mad. So I paused for a minute. I said, would you be happy if the 95% of the position you still own was down 20%? And to his credit, he paused. He said, I can't believe that I have not thought of it that way. And I thought that's how the emotion and the almost the gamesmanship of I want to try to nail this, whatever this is, a stock or a market or get in, get out, and it can wreak havoc with appropriate decision making. So I just love that anecdote of the way to think about how our emotions come into play.
But that is a big fear in a lot of investors. It's like FOMO. Oh, I sold NVIDIA at the top, and then it went up another 20%.
Diversification and rebalancing essentially smooths out the ride and lessens the likelihood that you make huge emotionally based decisions, either the greed in or the panic out. That's really the benefit of it. Not you're not going to have the bragging rights of, boy, I nailed this, whatever this is, at the bottom, and I nailed it at the top. And whether it's individual stocks or a group of stocks or sectors or even just broader asset classes, but smoothing out that ride is ultimately the key to not making those fear and greed-based decisions.
Any other essential investing disciplines listeners should follow?
Well, you mentioned dollar cost averaging, and that's always a great answer for somebody who is, you asked the question earlier about, boy, somebody who says, boy, I've missed out on this rally. What do I do here? It's just a beautiful exercise that doesn't mean you are trying to pick a moment in time to start to put that money to work. And everybody in general knows what it is, but it's surprisingly not embedded in a lot of the thinking. It's embedded in a lot of the advice, the formal advice that is provided by advisory firms, but it's not embedded often in the thinking of how to approach this by individual investors. The other thing I think, and this is a little bit more specific to the unique current environment that we're in right now, but a really important message for individual investors. I think sometimes individual investors get into, without maybe even realizing it, an institutional mindset. And I mention that because of the concentration issue with which we've dealt for a solid year and a half now around the Magnificent Seven or whatever subset of mega cap tech and tech related stocks you're talking about. And that has led, interestingly, to a misperception that I've had investors come up and say, boy, I understand the risk of concentration, but if I don't own those stocks in size, then I have no hope of doing well. And I always ask a question back, well, define doing well. You're not a fund being benchmarked against the S&P 500. There is nothing that says you have to own a similar size in those names. And most importantly, those names are the biggest names in the market. They're not the best performers in the market. They have been the largest contributors to index gains because of the multiplier of their cap size. They're not the best performers. If you look at the top 10 best performers year to date in the S&P 500, only one of them is in the Magnificent Seven. And it's maybe no surprise, it's NVIDIA. And that's not even the best performer. The best performer is Vistra, which is a utility stock. GE is on the list. United Airlines is on the list. If you go to the NASDAQ and you look at the top 10 best performers, none of them are in the Magnificent Seven. None of them are large cap stocks. None of them are household names. I'm 38 years doing this. I've never heard of a single one of them. The point is, there's lots of opportunities for performance. We get in this mindset of thinking our only hope to do well is to be in those names in size, missing the point that they're the largest contributors to cap weighted index returns, but they're not the best performers.
You've also talked about target asset allocation. Can you explain that for listeners and give some thoughts on how to maintain that?
We think of asset allocation as having sort of a strategic component and possibly a tactical component. So strategic asset allocation is the long-term plan where you have allocation to equities, to fixed income, to international versus domestic, to real estate, to commodities, to private markets. It could be a very robust set of asset classes that are part of a strategic asset allocation plan. And it tends to be long term. That doesn't mean it doesn't change over time as you move closer to retirement or you have needs for income or your short term cash needs, if you've got big expenses, et cetera, et cetera, et cetera. That might change. So that's the strategic asset allocation. Then there are investors who want to have maybe a tactical overlay, sometimes referred to as core and explore, where core is your strategic asset allocation, the on paper, here's what makes sense for my time horizon and risk tolerance and need for income and tax bracket, et cetera, et cetera. But, maybe I want to try to take advantage of shorter term biases in the market or opportunities, sometimes just via rebalancing strategies that can be that more tactical, shorter term approach. So that's the way we think of asset allocation. There's that strategic component, and then there's by choice, investors might have a tactical component of that as well.
No, me too. I love it. And that's how I explain to every client. They really grasp it. And some clients are tactical people. Some are strategic. Some are a little bit of both. It depends. So this is a Boston College retirement research professor. She was an assistant secretary of the Treasury under Clinton. And she's big on retirement income planning and academic. And I think she's 80, 83, just retiring now. And the article was on where she made mistakes. And it was kind of cool that she, this is some expert. And she was showing, I think her biggest investing mistake, she said, was taking her pension too early to invest it and not to let it accumulate and get those pension credits.
Right.
And I think if we got all these people who are talking heads and say, what are your biggest investing mistakes? That would be a great lesson, right?
And I also think probably one of the more consistent ones, if people are honest, is not starting early enough, not starting soon enough. My kids are in their 20s, but we always told them right from the get-go and starting their first jobs, we know it's early. You're not making a lot of money. You still want to have a social life, but do your best to max out your 401k. Try to put the maximum amount you can. There's just such a benefit of the match and everything, and so I think it's that start early message that I look back and I didn't start early enough, and I look back and I think I wish I had known more at the time.
No, me too.
There were no 401ks in the mid 1980s, so at that time it meant opening it up an IRA and knowing what to do with it once you opened it, which at 21 years old was not my expertise, at least at that point.
Start early is a big one. That's me too. I mean, I sort of came of age financially in the 9/11, 2000 to 2002 crisis. So that scarred me. I saw my parents lose everything. And
that was a tough bear market. That was brutal in its depth and brutal in its length. It's not always the case that you get the double whammy. Obviously, we did it from 07 to 09, but more often than not, bear markets can actually be fairly short-lived, even if they're fierce, like crash of 87 or the COVID bear market. But those long drawn out ones really, really test the mettle of investors, and they do a tremendous amount of emotional and psychological damage, no question.
You write about the unavoidable parts of investing. What are they? We maybe covered them, but this was a question my producers gave me and thought it was interesting.
Well, it should be avoidable, which are emotional based decisions. But I don't know anybody that hasn't succumbed to the fear and greed. And what's interesting is more recently, especially with sort of newly created acronyms like FOMO and HODL, that I think it's really maybe exacerbated the short-termism problem for a lot of investors, and investors thinking that maybe not that this is a game, but approaching it as such, and having time horizons that have shrunk so precipitously, given particularly the ease of trading and the very low cost, if no cost of trading. And I don't know, I think Schwab, may have had something to do with commissions going to zero last I checked. But so I think it's the same mistakes that investors make. There's maybe just a little bit different a flavor around them, and the provision of sort of easier platforms to make those mistakes. Clearly, they get masked by a bull market, which we've been in for a couple of years right now. But we shouldn't forget that there's always the other side to a bull market, which is a bear market. That's not my base case in the near term, but I think we always have to be on guard.
Definitely. We're going to go to the listening audience. We have Joe.
Thanks for having me up. And Liz Ann, it's a pleasure to speak with you. I follow your work and I really enjoy it.
Thank you.
So the question I have for you, and Josh and I have talked about this in other occasions, and I'm curious of your take. There have been many strategists, and I've heard from countless clients over really the last 2 years, really since 2022, that the yield curve inversion spells doom. That's almost a guaranteed, perfect score recession indicator time and time again. And obviously, at least certain portions of the curve, particularly the 10 and the 2 spread, is uninverted in the last 40 odd days. So I'm curious as to, I follow your work, and I tend to tell you my bias is that I think growth is going to continue to be strong, and I think the labor market's going to hold in there. It seems really resilient. So given that and no apparent signs of recession, I'm curious if you have any thoughts or impressions as to why the yield curve this time around may have given a false signal. Is that the effect of the inflationary dynamics or other variables in play, or if you've given any thought to that, why we might be seeing a false signal there?
Here are some of the caveats to that. The span of time historically between inversion and when a recession has started is pretty long and variable. Maybe we're sort of past the expiration date if you use history, but I think this cycle has been so unique, and we touched on in the beginning of this with this sort of elongation of the cycle given weakness in manufacturing, which tends to come in conjunction with an inversion of the yield curve, those being key leading indicators, and then it eventually morphs into the broader services part of the economy. Whether we've broken that relationship or just elongated the span of that roll through, I think time will tell. But it's also important that inversions historically, to use maybe a weather analogy, inversions have been the watch and uninversions have been the warning. Other caveats this time is number one, no major dislocations within the financial system, access to credit that has been ample outside of just the traditional banking system. Obviously, spreads remaining fairly tight, the private markets as a provider of credit as well. And just the nature of this tightening cycle, which historically would have meant more near-term weakness in the economy. I think there have been tempering impacts given how many important cohorts took advantage of what preceded this tightening cycle, which was ZIRP, zero interest rate policy. So you had corporations, particularly up the size spectrum, that termed out their debt and have actually been earning more interest on their cash than they're paying interest on their debt. Households that termed out and moved to fixed rate mortgages from variable rate mortgages, such that even at the high of 8.2% in the 30-year fixed mortgage rate, there was still a 3 handle on the average effective mortgage rate, with by virtue of an average meant there were a lot of people below. Now that's constrained the existing home market, but it has certainly prevented the kind of weakness in the economy. So I don't think we want to completely write it off as a failed indicator, but it represented one of those leading indicators, and it's embedded in the LEI, the Conference Board's leading economic index. And that I often get the same question, like, why has the LEI failed? Well, the LEI's economic components are manufacturing centric. That's not because the Conference Board is clueless and doesn't know that services is a larger driver of the economy. Normally what happens is weakness shows up in the financial indicators first, like the yield curve, like the equity market. Then it works into the cyclical side of the economy in manufacturing and new orders. And then it eventually morphs into services weakness. And maybe we broke that relationship, but we've at least elongated it. And that helps to explain why some of those measures just haven't done the job that they have had in the past.
Okay, just a quick follow-up. I appreciate all that. I'm curious then, what would, if we're sitting here in 2026 or 2027 and barring there's no recession, right? And things don't head south from here, labor market holds in there. At that point, would you feel comfortable saying that the relationship has broken?
Yeah, I think we would all be forced to rethink what the messaging is that comes not just from the yield curve, but other leading indicators. In fact, I think it's going to be interesting over the next year or two if we don't get an across-the-board contraction in the economy defined as recession per the NBER. It'll be interesting to see if the Conference Board does any rejiggering of the LEI, which they've done in the past. It's not abnormal for them to do it, but to me, that'll be sort of an interesting thing to watch, is if you see some of these leading economic indexes or recession probability models, whether they're adjusted at all for this unique set of circumstances, particularly if there's a perception that there's some longevity to those unique circumstances.
Yeah, thanks, Joe. Great question. I was just thinking when you were talking to Joe, what if the presence of 401ks, I think Mike Green or one of these people have to say this, that the presence of people every other week dollar cost averaging into the indexes, what if it's created this sort of world where none of these indicators matter anymore because just people keep plowing, almost like you have a floor on the market every 2 weeks with people's paychecks.
I think memories are short. 2022 was not all that long ago. We haven't outlawed bear markets. And 2022 was a bear market driven on the downside by the mega cap tech and tech related stocks. So let's not start putting stuff fully in the rearview mirror without understanding that we haven't repealed cycles. And there still will be bull markets and bear markets. So I think it's maybe changed a lot about the nature of how markets work and, passive versus active. But we had a bear market in 2022, and a lot of what you observed in looking at the nature of that bear market were true to past cycles. You had the initial big whoosh lower, but you still had pretty elevated sentiment, behavioral measures of sentiment. So in the mid 2022 period where you saw record breaking bearishness in measures like AAII, bulls and bears. That's an attitudinal measure. You were still just off an all-time high in terms of equity exposure. It wasn't until the October low that you had what I like to think of as the puke phase, where the attitudinal measures showed it, the behavioral measures showed it. You saw the washout from a valuation perspective. But as you were seeing kind of the crescendo low at the index level, even prior to that, you were seeing broader participation, sort of more of the soldiers were marching to the front line. That's kind of classic stuff. And that wasn't all that long ago. So I think there are forces tied to 401ks and how much money is in passive vehicles. But even on that front, look at where the biggest growth is in the ETF space right now. It's in active ETFs, not passive ETFs. So I never write off cycles as dead.
I'm a big believer in cycles. It almost seems like the classic, whatever you call it, 7 to 10 year business cycle has morphed into some strange, every other year people freak out. Like if you look at, there's like a 2-year cycle, it seems. December 2018 low, March 2020 low,
October 2022
to 2023 low. It seems like that's what I mean. It's distorting them, and maybe the presence of social media. As a result of changing interest rates, have you noticed any shifts in spending patterns or consumer patterns?
Not yet so much as a result of changing interest rates, but I think in terms of the consumption side of our economy, we can't look at the consumer through a monolithic lens, either on the behavioral side of things or the confidence or sentiment side of things. You are seeing vast, vast differences in terms of the health of the consumer, the health of households, depending on where you sit on the income spectrum, whether you're an asset owner, what share of your income goes to discretionary spending versus non-discretionary spending, even attitudinal measures like consumer confidence. The Conference Board breaks consumer confidence beyond just their headline index reading into 4 income zones. And maybe no surprise, the 3 lower zones have been in declining confidence mode. The only zone where confidence has been rising is in that higher zone. If you look at things like defaults and delinquencies, their real pain points have been down the income spectrum into the subprime categories. We're starting to see a little bit of sort of forward-looking perceived pressure in some of those attitudinal surveys about, how do you think the environment's going to look 6 months from now? Starting to see some cracks there, but this is not a backdrop where you can look at the consumption side of the economy with a monolithic lens. It is really not even bifurcated, as if it's really on a spectrum. And I think you have to look at it on that spectrum. Because the consumer isn't just one thing. That, by the way, that may seem like an obvious comment, but during the surge in stimulus and the coming out of the lockdown part of the pandemic, you could actually look at the consumer through a monolithic lens. Savings rates across the board jammed up to 30%. Excess savings was through the roof. There was pent-up demand pretty much by everybody. And even when services opened back up, you could. Now I think you've got to understand the breakdown of the consumer and where you're seeing those pockets of weakness, but where you're seeing that ongoing resilience.
You wrote an article called "Panic is Not a Strategy, Nor is Greed," which I like because people are greedy right now. Yeah. So what did you learn when writing that article that you'd like to share?
Josh, interestingly, I first wrote that article in the throes of 2008, and I have updated it several times since then, not only when there seems to be an air of panic, but I've often updated it with more of an emphasis on the "nor is greed" part of the subtitle. So it's kind of this tried and true reminder that it also is. I love when I feel like it's time to update that, because then there's less writing for that particular week, because I just have to put editing touches on that tried and true report. But I think it's both the greed side and the panic side that comes into play. And there's lots of stats in there around the peril of panicking and just the nature of how markets work, and data around some of the best short-term periods of performance in the equity market have come in the immediate aftermath of some of the worst periods of performance for the market. And it's another way to think about the peril of trying to time markets, because you have that bullwhip, that boomerang effect that can happen in the short term, further supporting the idea of not buy and hold, just stay in, but having that discipline around things like rebalancing. The one thing I will say about this recent momentum-driven market is it doesn't trouble me as much as what we saw a few years ago, when the hype in the market was that's when you had, the acronyms of FOMO and HODL, and you saw the advent of these trading platforms. It was the meme stock era, it was SPACs and NFTs, and it really just was sort of silly season. That doesn't mean there aren't excesses from a valuation perspective right now, but here's an interesting comp, not to the meme stock era, but the last time we saw momentum as a factor be as dominant as it has been recently was in the late 1990s. But momentum is not a fundamental factor. It's more of a concept. It just means that stocks that have been doing well continue to do well. It doesn't say anything about what the fundamentals are of those stocks. And what's interesting is in the late 90s, when momentum was as dominant a factor as it is now, the fundamental factor most correlated to momentum was negative earnings, versus the more recent period, and it's multiple factors that at times have been most highly correlated with momentum, have been factors like high return on equity, strong free cash flow, high interest coverage. That doesn't mean we're still not talking about rich valuations, but the momentum is in stocks that there's some there. They actually have cash flows and earnings and revenues and visibility there, versus just what we now know with the benefit of hindsight, a lot of the nonsense that was driving the market higher back in the late 90s.
It's a great point. Going to our listeners, we have Theta. Go ahead. You're on with Josh Jalinski, your financial quarterback, and Liz Ann Sonders of Schwab.
Liz Ann, I couldn't resist the opportunity to come up and say thank you. I'm a longtime Schwab client. I actually had my first account there a little bit before you joined. Do you have concerns about the Fed's inability to shrink its balance sheet back towards zero long term?
I think the process of the Fed shrinking its balance sheet will be a long-term process, and I think they might have to sort of pull back and push forward that lever from time to time. In terms of the broader question, you're right to point out that regardless of who wins the election, there is very little fiscal discipline. We're in an incredibly divided environment right now from a partisan perspective. But if there's one thing that both parties do really, really well together, is not care a lick about this problem. There's no constraint of thinking, and it is frustrating because this is a long-term problem. It's a short-term problem and a long-term problem. I don't really worry about some sort of Armageddon point, some crescendo point where interest rates go through the roof in order to entice buyers. There's still 80% of global trade is still done in dollar based. We have the most liquid financial markets and bond market. There's ample demand for treasuries, even in the absence of the Fed stepping away from being the ultimate insensitive buyer and the largest buyer. There's been ample demand for treasuries. We're now ostensibly in a declining interest rate environment, so the interest cost piece of it starts to come down. But the biggest implication of a high and rising burden of debt, which comes from running deficits, is it acts as a suppressant on economic growth. That's not a prospective phenomenon. That's a phenomenon with which we've been dealing for quite some time, and frankly, most of the rest of the world that is at a very high debt level. It is not hugely inflationary in and of itself. I mean, Japan is certainly an example of that with 250% debt to GDP, and they've been trying to claw their way out of deflation for decades. So we don't see it as some tipping point. What's interesting is I have never done an event, a podcast, a virtual client event, a live client event, where I don't get this question from investors. And I think that references the fact that the investor class cares deeply about this topic. I think the average person, the average constituent, maybe cares about it in the abstract, doesn't vote based on it. And as long as they're not voting on it, neither side is going to do anything about it. In a perfect world, what you do to start solving this problem, which is a process over time, can't be a moment in time, say for default, which we don't think is in the cards, is to have debt, the growth rate in debt be lower than the growth rate in the economy, because that's how you start chipping away at the problem. There's just not much incentive for either party to do anything about it. And that's in part because their constituents aren't saying, we're going to vote you out if you don't pay attention to this. And so it sort of is what it is.
Like the old Warren Buffett rule. I saw something on Instagram the other day. He had some rule to solve the debt, just cap it by GDP, or else Congress loses their job or something like that.
Or they don't get paid. Imagine that.
Yeah.
Yeah.
I had Steve Moore on, I don't know, a couple months ago, and I said, what assurances will you give me to, that Donald Trump, if he's elected, I don't want to get too political, will freeze the national debt or do something? Like, I always thought the Mac Penny plan was a good one, where each department has to cut their budget by 1% a year. And then if they do that for 8 years, it'll, along with the growth in GDP, should have a sizable, take away a sizable chunk of the deficit and the debt. He seemed to, he swore to me that Trump's going to do something this time. We'll see.
Again, on the surface, we don't know what yet is going to happen in terms of policy proposals to policy. Obviously, that's a function of the makeup of Congress. But policy proposals and policy actually getting enacted are two entirely different things. And it's incredible to me how often people forget it and how often I see headlines and I think, boy, you should know better, where it'll say, Harris will raise taxes, blah, 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 or Trump will lower taxes. That's not how policy is made.
Yeah, the Trump tax cuts were no more than the Bush tax cuts, edited a little bit from the Obama administration, edited a little bit from, Paul Ryan. It was really more of Paul Ryan.
Well, and extending all of
creation.
them, which claims to be what the Trump and his people would want to do. Not every Republican is in favor of extending all of those tax cuts. So again, I don't want to get into the politics of this, but it's just another maybe specific example of be careful what you extrapolate in a campaign season.
Yeah, I also want to be optimistic. You're an optimistic investor. I want to be an optimistic observance. I want the country to do something about the debt. So I want the old Ross Perot, videos out there. So maybe nobody ever thought Newt Gingrich and Bill Clinton would have converged on the national debt. So maybe we'll have some.
Hey, those were the days of Gingrich and Clinton and, O'Neill and Reagan of, fight it out on the proverbial or literal floor, but then, get stuff done.
So maybe we'll get lucky, I'm going to be an optimist with that because our country needs it no matter what party you are. So parting thoughts, which sectors do you like right now? China's hot. Everybody's talking about China.
My colleague, Jeff Kleintop, is our international strategist, and the perspective he and his team have had on China is that some of the stimulus is pretty massive, but it probably only provides fits and starts in terms of consistent leadership on the part of the Chinese equity market. And that is probably going to be a pretty volatile ride. Outside the U.S., the bias that group has had, our group, and on the international side has had within developed international markets has been more on the Japan side of things, and within emerging markets, more on the India side of things. In terms of sectors in the U.S., we do have what we call Schwab sector views. We have ratings on all 11 sectors from outperform to market perform to underperform. And the two outperform ratings are on financials and materials. But we have really been emphasizing factor-based investing, at least as an overlay to sector-based investing. So quality-oriented factors like return on equity and high interest coverage and positive earnings revision trends and strong free cash flow and provide that as an overlay on top of the sector work, because that's where leadership has been much more consistent, is at the factor level. Much like I said, you can't look at the consumer monolithically. Be careful about looking at sectors monolithically. So apply that factor-based or characteristic-based screening on top of any sector work.
No, great. Thank you, Liz Ann. Anything you want to share that you didn't have time to share in today's interview?
I'm just happy my voice held out on me and I didn't have a raging coughing fit, which I did on a prior appearance. So I'm very happy with my
You
own
were healed.
vocal cords that I managed to get through this. But I really enjoyed our conversation, and I love the fact that you provided a platform for actually talking a bit about the stuff that matters, in addition, not to the stuff that doesn't matter, but the stuff that we all are more interested in, what markets are doing and sectors. But I think some of those long-term disciplines should always be filtered into any more fundamental conversation about where are we in the cycle.
But great. This was so much fun. Liz Ann Sonders, anything you want to plug besides your On Investing podcast? Make sure you go to Apple, Spotify, get the On Investing podcast.
Well, let me unplug something, for lack of a better word, which is, I am on social media, but I am only on X and LinkedIn. Public service announcement. I have had a shockingly large number of imposters on Instagram, on Facebook, on WhatsApp. Most of them purporting to be me, using photos over the years, showing my profile banner, claiming that I have a private stock picking club where I'm guaranteeing some huge percentage gains with these 3 stocks. And it's a money grab that feeds people into WhatsApp. None of them are me. We play whack-a-mole. There's a team of people at Schwab that are in the legal and compliance, are working with Meta to get these taken down. There have been days where there have been 150 to 250 of them up. They'll all be taken down, and then within 2 hours, 100 of them are back up. So if you think you are following me, or you want to engage with me, or you're interested in my stock picking club on Instagram or Facebook or WhatsApp, it is not me. I am only on X, and I'm at Liz Ann Sonders. I have 430,000 followers. I don't have 43 followers, and I'm on LinkedIn. Period.
Yeah, and you got to make sure her name is spelled right on Twitter,
No,
so you don't get
exclamation points or dollar signs or 2 Z's, or just at LIZANNSONDERS. Period.
That's a good personal finance tip, because there are a proliferation of these like spoofing accounts, and some of them. Oh, who did I see the other day? It was somebody like Ray Dalio, or
Ray has had imposters. Muhammad Al-Arian has had imposters. Larry Fink has had imposters. Believe me, it's not just me. I'm less high profile than some of those people, but it's just a bummer that people that are intelligent enough to be able to do that can't put it to more productive legal uses. It's annoying.
So make sure you follow Liz Ann on Twitter, on X. I always say Twitter, but
I still say
on
Twitter.
X, at Liz Ann, LIZANN Sonders. I'm assuming your legal name is Elizabeth. My wife,
Elizabeth Ann, yes.
Comes from a line of Elizabeth Anns. There's like 4 in a row. Is that you too?
I'm Elizabeth Ann. Yep.
Yeah. And how many Elizabeth Anns in your family? A bunch or no?
Nope. And in fact, Sonders, which is my maiden name, is an invented name by my dad. My dad changed his name when he was 26 years old. I'm 100% Norwegian, and my real last name is Sodafjed, which has the FJ combo, like Fjord. Yeah. And that was an era. He was first generation. Both my parents were first generation Americans. That was the era of wanting to be American and sound American and have an American name. So he decided he wanted to keep the first 2 letters, SO, but make it easy to pronounce. So that's why when people say, "Oh, I met somebody named Sonders, are they related?" And typically it's SAUN. So but I always say no one with the name Sonders is related to me, other than my siblings. Well, you know where Liz Ann came from?
What?
I was born in 1964, and Liz Ann was the name of Grace Kelly's sister. who got a lot of attention at Grace Kelly's wedding to Prince Rainier, similar to Pippa Middleton getting a lot of attention when Princess Kate got married to Prince William. And Pippa became, I think, the number one chosen name for girls in the aftermath of that wedding. Well, Liz Ann sort of stole the show in that wedding. And the only other Liz Anns I've met in my life, and I've met maybe 4 or 5 of them, were all born in 1964. So, fun fact.
Wonderful. Well, great
Thank
to
you.
spend time with you.
You too.
Everybody, make sure you download the On Investing podcast and follow Liz Ann on X or LinkedIn, not on Facebook or Instagram.
Or WhatsApp.
And be sure to also download this conversation on the Financial Quarterback podcast on Apple or Spotify. Follow us on YouTube and like us on X.